Namaste, Sat Sri Akal and Adab. Welcome back to another episode of One on One with Mr. Bond. Today's guest, I had interviewed him during the NFO launch of large cap fund of Motilal Oswal. And since then to now, it has been the best performer in terms of the category performance of large caps. In music parlance, I can say that they are back on top of the charts. As I had mentioned with my interview with Akhil, that practically in all segments and in all categories, they are on top of the charts and on the playlist of every investor and mutual fund distributors. So I want to revisit the call which we had, the interview which I had done with Atul Mehra, the fund manager for large caps, and see what has he done right to have come up with such a performance. What should the investors expect going forward? The current market conditions and the valuations. All these are the topics which we will discuss during this conversation. Welcome, Atul.
Thank you very much, Sunilji. Thanks for having me on the show.
So, Atul, I had interviewed Akhil in the last couple of weeks back, and I had spoken about how Motilal Oswal as a fund house has bounced back, and you are on top of the charts in practically all the categories of schemes which you are managing. Again, in the music parlance, you are on the playlist of almost all the investors and mutual fund distributors. And you have once again proven that with the record which you have shown from February 2024, when you launched your large cap funds till now, almost 10% alpha over the benchmark, which not many people expect. That, the myth is that in large caps, you cannot generate alpha. And you have broken that myth. What did you do differently?
Great. Thank you. Thank you for the question. So I think, like we had mentioned, even at the time of NFO, in terms of the way we were supposed to manage the fund, it'll be much more active than the typical large cap fund. So we have taken in terms of investments in businesses which are in terms of more broad based. Like for example, some of the aviation names have done very well for us. Some of the automobile names have done very well for us. And also in terms of defense names have done very well for us. So you would generally typically in a large cap fund, most of the allocations are towards the typical in terms of sectors, but some of these allocations for us have done very well. Additionally, one thing that we should note is in a large cap fund as well, we have 20% leeway of in terms of buying businesses which are outside of the large cap space.
Sure.
Right? So that again is a very powerful in terms of element of in terms of opportunities where our highest conviction ideas that we believe can in terms of do exceptionally well. So that 20% contribution from the perspective of overall allocation in the fund, that also has done very well. So for example, some of our consumer discretionary names in that 20% in the mid and small cap space has done very well. Then also like holding companies as a theme is something that we like. So some of our investments in very well run businesses within the financial services space, but through holding it through a holding company structure where we believe which can create much more value. So that has done exceptionally well as well. And so on and so forth. So basically addressing the large cap space with a little bit of a differentiation from within the overall large cap space, as well as the 20% in terms of lever that we have to invest in outside of large cap space. The combination of two is what we believe has helped us deliver returns in the last 7 months since the NFO was launched.
Awesome. Now, there were some events which were likely to happen and which have already happened since in January to now. Now, in January, we were waiting for the election results, as you remember. We were waiting for Fed rate cuts also, which we were expecting in the month of March or in the month of June, which has not happened. Election is behind us. We were waiting for some of the corporate results also. So if you revisit all of these or some of these, election results were mixed bags. Corporate results were also again mixed bags. The rate cut has not happened as far as Fed is concerned and likely to happen in the current month. So what are your thoughts on where we stand, where we stood in January 2024 on some of these events versus where we stand right now?
Sure. So I think firstly, I think the biggest in terms of event in the last 7 months has been the election. So what we saw was the leading party, they got about 240 seats. versus I think the last time around they got about 305 seats. So there was a deceleration in terms of the number count for BJP as a party. But I think when I talk to a lot of international investors and a lot of people who look at India from the perspective of a global lens, actually a lot of people are quite happy with this result from the perspective that um, so there is a term called, say, political correction that a lot of people spoke about, where they say that like an absolute majority beyond a point tends to result in things which are in terms of quite extreme. Like we've seen in the past a demon or demonetization, or in terms of number of other reforms that the government took place where they did not have to consult other parties. But with
Correct.
a 240 kind of a majority,
There is some check and balance, checks and
there is a
balances
check
in
and
place.
balance. Absolutely. So there's a check and balance in place, which means that you will not have any kind of extremity per se. And also, especially if you look at the global experience, right? So the global experience where there is absolute aggregation of power for a long period of time, there some of the things have on a global basis not been too good in many emerging markets. So I would say that although, like, as local Indians, we would have thought of it being a negative event, but when we look at it from a global investor perspective, I think it's more or less a neutralish or a slightly positive event as well.
Okay.
So that, I think, in a way, the interpretation of how the election results came about, and we saw that, we all remember the election week volatility, where you had like 7% down in a day, and then the very same week you ended in the positive for the week.
Yeah.
So we all remember that, and I think more or less, I think we have all digested the election outcome in terms of per se.
So
The
now what
second
do
is
you
that,
expect? The rate cut, which was
yeah,
likely to happen,
coming.
which has not happened?
Yes. So the second thing is around the rate cut. So if you look at it at this point in time, the data on the US side is approaching towards a little bit of a slowdown. Multiple indicators point towards that, and most likely we would look at the September 18th Fed meet. Would likely see maybe, if not a 25, then maybe also there's a high degree of probability building up for a 50 basis points rate cut as well. So more or less, I think even in the latest communication that the Fed has had, we believe that they've also indicated that it's just a matter of time that the rate cycle reverses, and now it's only a quantum of whether you have a 25 basis points or a 50 basis points cut. Additionally, I like to point that if you look at the 2-year Treasury rate, it's actually approached almost like a 2-year, 3-year low, which is suggestive of the fact that in terms of the near-term outlook on economy has slightly worsened for the U.S. economy, and the rate cycle in terms of is about to turn very quickly. So those are the two things. Having said that, I would also like to point out that as because the market is always about the future, and some of this is already digested, and the future that the market will look at from the U.S. perspective is the U.S. election. We had the presidential debate, I think, just yesterday. And I think the next 2 months will all be about US elections. I don't think it will be too much about rates anymore. And the market's focus will be on the election outcome, and the kind of policy that the new government will likely shape in the US.
So Atul, tell me now, rate cut is supposed to be cheered as a positive signal for the markets because corporate balance sheets benefit out of that, retail consumers benefit out of that. But that is a admission by the Fed if they come up with a 50 basis rate cut versus 25, that the economy is really slowing down. So is that recession round the corner? Is US in trouble going forward, irrespective of which government comes to power?
So what I think is, in terms of if you look at the policy environment at this point in time, it is more towards like I said, the rate cut is more or less coming. 25 or 50 is a quantum that we need to look at in the next few days. Now, I think the more important aspect is going to be the election outcome. So because a lot of policy is what is shaping economy to some extent. So, for example, say say Trump is talking about potential tariffs to a large extent on on China, or for that matter, other policy changes around immigration and so on and so forth. So a lot of these things will determine the economic growth. For example, if you think about it, 1% GDP, 1% population growth in the US comes from immigration. Like they have like 3 million immigrations every year on a $300 million population base. So if you restrict in terms of incoming people and the labor force and the overall like GDP is only a function of labor and capital and productivity. It's in a way a function of the three elements, right? So if you control one of them, like labor, for example, or if you have tariffs imposed on Chinese, which makes imports very expensive, which can be very inflationary in nature. So you never know. Like so, some of the things are extremely dependent on how the policy would be after the new government comes into picture, and hence there will be like a little bit of a discontinuity of the current versus after November when we have the new government in place. So I think the market will really look at the future on the election, and that is most likely going to be the most important in terms of variable to track in the next 2 to 3 months.
So two catalysts which the investors should be looking out for is, one is the 18th September rate cut by Fed, if at all, and how much it happens, and of course the November elections.
Yes.
Now, the equity markets generally move on two C's, as we say, capital and crude. Crude is in favor of the markets because it's almost at an all-time low, so to say, below $70 also. But the capital flows, what we are seeing, DIIs are the net buyers, almost 3 lakh crore plus inflows in the current year to date. But FII are still negative to the extent of almost 1.4 lakh crores.
Right.
So if that be the case, when do you see? And the other aspect of the matter is that in the emerging market index, correct me if I'm wrong, MSCI emerging market index, I think India has now a higher weightage than China. So that's positive as far as India's capital flows are concerned, the portfolio flows are concerned. So where do you see and when do you see the FII money coming in?
Right. So I think if you look at the current rally that we've had over the last 2 3 years, it is completely a domestic flow-driven rally.
Absolutely.
And even at this point in time, like if you look at the monthly flows that we saw on the mutual fund, which was released a couple of days back, almost approaching like 40,000 crores a month. So 40,000 crores a month, if you analyze that, that's about 5 lakh crores of flows. That's in terms of extremely sizable in terms of flow from the domestic, just mutual fund side. There are other domestic institutions like insurance.
This includes the SIP flows also, right? That 40,000.
Everything. This is the net flow for the mutual fund industry. So it is a very, very sizable set of flow which is coming in through intermediated products like mutual funds. And then there is, if you look at it, we've crossed about 17 crore demat accounts last month, right? So there again, the momentum on new demat account openings is also extremely strong. So not just through intermediated products like mutual funds, but even direct investing through opening a demat account and so on and so forth, even that is extremely strong. So to that extent, if you look at it, while FIIs haven't participated and we haven't seen that change materially, the domestic investors in terms of investments continue to be very strong and approaching new highs every successive month. So I think that is really playing out to be a very important factor for the market. On the offsetting side, if you look at it, there is also money being taken away by new offerings. For example, we crossed almost 85,000 crores of IPOs in the current calendar year alone. Like from January to September, we've had 85,000 crores of IPOs, and there's been quite sizable QIPs and offer for sale and promoter blocks as well to some extent. So there is if you look at it, there is on one end, there is a domestic flow coming in from mutual funds and other products. And on the other side, there is new paper to the market in the form of IPOs or QIPs or private equity sale or promoter sale and so on and so forth. And the balance even now seems to be a little bit in favor of the positive versus the negative. So hence the market continues to chug along. And despite in terms of significant amount of paper being
So how long can this DII money prop up the markets? because valuations are not so cheap anymore. They are, of course, getting stretched only. So we'll come to the valuations a little later. But when do you expect the FII money to come back, after the rate cut happens or post the November election results? And if that happens, then of course the large caps will benefit maximum in terms of the flows which will happen.
Right. So far, what we've seen is like, just to come back to the question that you raised around MSCI emerging markets. So I think even now China is slightly higher than India in terms of weights, but a lot of portfolio managers within the EM in terms of vehicles are overweight India and underweight China to some extent. So to that extent, portfolios in the existing EM vehicles are positioned towards India in terms of positive allocations. But what is happening is that the emerging market vehicles are not seeing inflows because emerging markets as a basket hasn't done well over the last decade.
Right.
So India has done well, but India is only 20% of the emerging market pool. Right. So if your 80% hasn't done well, because of which the vehicle is not seeing particularly strong inflows. Right. So and overall, if you look at it, almost 90% of the money that India has from foreign investors, it is through emerging market vehicles, right? So India dedicated is less than 10%. So
Okay.
hence, what you've seen is, emerging markets, the story hasn't really changed much. Like the issues around China geopolitics and slowing economy and the debt issues, etc., they continue. So EM as a vehicle has not seen any particular traction over the last 6 months either, like we've seen in the last 2 3 years. And hence there is not major flow from FIIs in the Indian markets as well. Like they already overweight, and then the vehicles are not seeing a major inflow, because of which there is no major inflow in the Indian market. So
one more data point which I wanted to share with you, Atul, which we had discussed about it last time also, was on 31st March 2021, FII participation in Indian equity was almost 21%, which was approximately the highest levels in the last 3 4 years. But currently, as on 31st of March 2024, it was as low as 17.7%.
Right.
So every 1% flow from FII will add about $55 billion extra money coming into the Indian equities.
Absolutely. Yeah.
Am I correct in saying that?
That is right. Yeah, that is right.
So that window is still open. The way we are talking about 14 crores growing to 18 crore or 17 crore demat accounts and the direct equity participation by Indian retail investors, there is a possibility of some flows coming from the FIS segment because of the low ownership of Indian equities.
Yes, but only thing is that doesn't seem to be changing very quickly. So the emerging market vehicle doesn't seem to be attracting any major inflows at this point in time. So what the way I see it is, at this point in time, it appears that the market will continue to be domestic flow driven rather than FII flow driven at this point in time. That might change in the future, but at this point in time, it seems that it is more or less a continuation of the same trend rather than a change in trend.
And we don't see any stumbling block as far as the flow of the DIIs is concerned as of now.
So if you look at it, I think
what
we are going through.
Can break that? What I'm trying to ask you is what can break that trajectory of DII flows?
So the way I see it is, if you look at it, what is really happening in DII flows is we are actually going through a penetration story, right? So whenever like you're going through a penetration, so just imagine even today we have only 4.5 crore unique mutual fund investors in our country. So we have about close to 70 crore PAN cards, right? And individuals would be maybe more than 55-60 crores PAN card holders, right? Of that, you have only 4.5 crore mutual fund in terms of investors in India. So hence the combination of higher and higher number of people increasing and opening accounts towards mutual funds or demat accounts, which is a penetration story, and the dual combination of collapse of fixed income.
So there's a structural change in terms of the way the behavior, the way in which the investors are investing. So financialization of investments is happening, which used to go earlier in real estate, gold, etc., is now coming into the mainstream, which is the equity markets, the debt markets, etc., capital markets. So that
also
is a
what's happening
structural
is the word spreads, right? So for example, So what is a very successful product? A successful product is where a customer has a very good experience and he talks about it to 20 other people, right?
Right.
Now, I think equity mutual fund today is a product which is that successful product. So people have
Correct.
money, they talk about it well with other friends and family, and the word spreads. And that's how other
And the
people come
campaign
in.
mutual fund Sahi is also helping.
Absolutely, absolutely. So, but more than anything else, I think it's just that the product has delivered value to investors, like, and because it's a good product, it is basically spreading in word, and people are acting on it. So, I think
Sure.
that is the essence of why mutual funds are doing so well.
Right. Now let's talk about the Goldilocks macros of India. The inflation is under control. It's one of the on the lower side only, and it's going towards a trajectory which is on the downside. Current account deficit is also very low, thanks to the crude oil helping us. The fiscal deficit number in the budget announcement is on a consolidation path from 4.9% to next year maybe 4.5%. Corporate earnings and balance sheets of banks are very healthy. Crude oil, as I said, is on the positive side. It's absolutely low. And the peaking of the interest rates. From here on, if the Fed cuts interest rates, I'm sure RBI will also follow. So all these are extremely positive macro factors as far as India story is concerned, with 6.5, 7% GDP growth numbers. So what do you have to say about these macro factors which are playing out in the Indian context?
I
And how
think
long will they last?
sure. So I think in terms of macro, we are favorably placed. I think just that what is very important is at this point in time, I think India has this opportunity. If you look at it from a global lens perspective, like uh, you have very few countries which are as large as India, and where you have a democracy, you have a stable leadership, and you have a extremely strong external side. Your external debt is like fully covered by our forex reserves, and you have a GDP which is growing at 6.5%, and enough number of people to employ, and the policy environment is quite favorable for foreign investors to come and set up shop. Now, add to it the global geopolitics. Like everybody in a global boardroom today is looking to diversify supply chain. Right, supply chains in the last 2 decades have been built and completely relied upon through investments in China. But every boardroom today, like the single largest discussion is around de-risking. And when it comes to de-risking a very large supply chain like China, you have very few opportunities other than India. So I think it is our opportunity today, and it is for us to capture this opportunity. We are already seeing in terms of number of moves in terms of domestic manufacturing, like for example on the electronic side and chemical side and so on and so forth. But I think the scope is extremely large. So we are even today like hardly a $4 trillion economy, and we have even today like while our economy is fairly large, if you look at it on a per capita GDP basis, we are still 140th in the world at $2,500. We are amongst the poorest countries in the world at $2,500, and we rank 140 on that. So there is a significant room to improve per capita GDP and lifestyle for our citizens. And I think in the next decade, it is if we make all the right efforts and attract the right set of global investments, we can absolutely build this GDP and economy for the next 2 or 3 decades. So I think all the stars are aligned. It is just that you need to execute, and I think that's the key.
So
So
let's now talk about the elephant in the room, which is the valuations.
mhm.
So, either the earnings have to continue to grow at the pace at which they were growing. Otherwise, the markets will become more and more expensive only. Or if the earnings growth starts to slow down for whatever reason because of the global macros, we will have an issue in terms of the stretched valuations, both all in all the buckets, large,
Mhm.
mid, and small caps.
Right. I think the market is kind of going sideways based on if you look at it the more recent times. And there is a lot of, in terms of incremental activity happening on the primary market side, right? So where you have new opportunities coming about, and new set of businesses coming about, and those are the incremental in terms of alpha opportunities as well to some extent. And to some extent, like we also discussed earlier, there is a lot of new flow in terms of domestic investors, but at the same time, there is also a lot of new paper in the form of IPO, QIPs, and blocks, and so on and so forth. So to some extent, they are in terms of matching each other and would likely match each other, and hence, and typically what happens is like this is a, I think it's a natural concept. Like if things are on the higher side, there'll be people who will come about and capitalize on the opportunities and so on and so forth. So to that extent, the way I see it is maybe the market will likely be consolidating for a period of time.
So there will be a time correction, so to say?
Yes, to some extent, a time correction. And at the same time, you have opportunities which exist on the primary market side. We have participated in a number of primary market opportunities in the last 6 to 7 months, even within the fund. Um, and uh, and hence, to that extent, as long as there is supply meeting demand, the secondary market valuations are not going through the roof because, say, for example, there was no new IPO.
Liquidity will not really drive the valuations of the market because of the enough supply being there, both in primary and the secondary space. Am I hearing you say that correctly?
So supply is catching up to meet the demand for equity, and hence that is keeping a lid on overall secondary market valuation.
So there's no euphoria building up.
Yes, because in the absence of say any new offerings, the 5 lakh crores you'll buy companies that already exist, and you'll bid up the stock prices for those companies, right? But because you have like 3-4 lakh crores of supply coming about, right? So that money is getting allocated towards those opportunities.
Correct.
And hence, that is not having an adverse, irrational price impact on the secondary market stocks.
So there is enough checks and balances within the system itself also.
Yes, so this is a natural mechanism to that extent. Like it is like we always say, like markets tend to also self-correct to some extent without like any kind of intervention by anybody. And this is the natural self-correcting mechanism. Like for example, there will be people who will come and sell equity and raise money for building new plants, or promoters wanting some liquidity because they made tremendous amount of wealth in their business. It's not wrong for them to take away like 100 200 crores for building a better house or building a better lifestyle and so on and so forth. If you've created a business worth 10,000 crores, why should it be in terms of looked down upon that you sell 200 crores worth of stock? So
Correct.
so I don't see that as an issue. So
but somewhere I read, Atul, that a lot of the promoters are selling their stakes. Is that a concern for the retail investors?
So to some extent, yes, because whenever a promoter is selling, it's also suggestive of it could be suggestive of like overvaluation. It could also be suggestive of the fact that if the company is worth 10,000 crores, if he sells 200 crores worth of stock, he's selling just 2% of his equity, right? For a better lifestyle, he might want to buy a home or whatever else, right? And there have been enough number of cases in the past where promoters' stock has been bought by investors, and the stock is up 10x after that because the promoter maybe he wanted to buy a house worth 100 crores, but the investor saw value in it, and the stock is up 10x today, right?
Right.
So this is a function of the markets. But
So
what I'm saying is, what I'm saying is basically these things should not be looked down upon, because in the past, like whenever promoters sold, we always looked down that this story is over. But no longer that's the case, because everybody has aspirations and everybody has a right to diversify their in terms of asset base. Like why shouldn't like a promoter who's built a business worth 10,000 crores sell 100 200 crores and have some safety net for him? So I don't see any negativity in that.
Now tell me your parting thoughts. Now, how do you expect? Because you started with a big bang. His outperformance is phenomenal. How will you continue to stay the course and deliver? I'm sure you cannot replicate the returns of the past, but how do you expect that the investors will continue to benefit from your style of management?
Sure. So I think we are still, in terms of the opportunity, is very large. There are a number of businesses, like I was mentioning, um, within the large cap space, which will do well from here as well. And at the same time, there are opportunities in the mid and small cap space, which through the 20% bucket that we have, we will look to in terms of identify and own them in the portfolio. Additionally, like I mentioned, there are opportunities on the primary market side, where you have a new set of very interesting businesses coming to the capital markets, and which we will look to participate in the fund as well. So I think this has been the success formula so far for us. Combination of differentiated large caps, and differentiated portfolio positioning, and mid and small as well. And it would be more of the same in terms of the strategy that we would look to deploy in the future as well. So so that's the way I see it.
Any final parting thoughts for the investors at the current juncture? What should they be aware of in terms of the risks which are around the corner?
So
If
I would just say that I say this all the time, that equity is a long-term asset class. So only look at investing money in equity, which you want, which basically you can do away with for the next 10 years, because markets are always subject to volatility, right? And you shouldn't need that money if at all we have any kind of drawdown on the market, right? So look at asset allocation, look at equity from a perspective of a 10-year perspective of investment horizon, and also look at it from a systematic investment perspective. Don't get overswayed with it. Look at keep like you should consult your wealth advisor in terms of asset allocation that is right for you, and stick with it without getting swayed by the markets in any particular extreme form. I think that's the key. End of the day, allocation matters most in the long term.
Thank you so much, Atul. As usual and as always, it's a great pleasure having you on the show. I hope you continue with this stellar performance going forward also, and all the investors benefit out of that. Thank you so much.
Thank you very much, Sunilji, and we will make all our efforts to make sure that we continue with our performance. Thank you very much for your time and for this opportunity.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.